Thank you for joining this session. My name is Abdullo. I'm part of SAS Risk and Finance Advisory team in Asia Pacific, where I advise financial institutions on topics related to corporate and retail credit process, credit risk modeling, decisioning, and application of machine learning in credit risk management. Before joining SAS, I held various positions in risk management in European banking groups. The massive economic shock from COVID-19 has made planning for the next normal increasingly complex. Today, we will share views on what is happening in the financial services industry, what is this new normal, how organizations can adapt to current conditions, and post-crisis new normal. Today, hundreds of millions of people are still in lockdown. Production levels are slowly picking up from being idle for months. Borders are mostly closed. Companies are running out of business. Gig economy is collapsing. The loss of income for many households and firms means that private sector debt levels will become unsustainable, potentially leading to mass defaults and bankruptcies. Unemployment rate in some countries already at an unbelievable rate. While Asian economies are expected to continue recovering, the recoveries are unlikely to be fast or complete until better treatment or vaccine makes its way, which may not occur until the second half of 2021. The latest trends in economic data reveal that the global financial crisis of 2008-2009 may turn out to be a small blip compared to the current economic situation in Asia. Regarding financial services, global capital markets of COVID-19 has generated significant instability and high volatility. The full impact is yet to be determined, and this uncertainty will remain for some time, in line with the overall recovery process going beyond the second half of 2021. While it is reassuring to see some aggressive fiscal and monetary policy responses around the world, it is expected that the adverse impacts are likely to happen. This includes the possibility of unexpected recession in the most advanced economies. Countries like Singapore, Hong Kong rely a lot on financial services. Some of the areas within the industry that are likely to be most impacted by COVID-19 and being on top of the attention lists are profitability and credit management. As liquidity and funding globally will be unstable due to the global market turmoil, organizations need to look into how they will use the liquidity they have to fund renewals of revolving credit lines and new extension of credit, rethink their ALM balance sheet management strategies. As existing risk assessment models' performance is deteriorating, lenders need to reinvent approaches to risk assessment. Low interest rate with stressed cost, including increased corporate and consumer credit risk, is reducing the core banking profitability, shifting focus toward commission-based income and a driving need to launch new non-credit and credit products. Another area is channels, customer relationship, and commercial models. Organizations which heavily rely on in-branch operations need to reimagine their operating model and digitalize. Experience customers will have with their financial organizations now, especially in the area of credit risk products, will have long-term implications. Let's dive in credit risk management area. Globally, we see that use of existing lending models and strategies as this is not possible. Some lenders had to almost halt their lending operations and cut down their existing limits as they are struggling to assess credit risk in a new environment. And this is clearly not very good for their businesses. Other lenders are reviewing their risk decisioning, portfolio management, and risk modeling approaches, while similarly to earlier recession are raising credit score cutoffs, implementing supplementary judgmental scorecards, putting policy rules restricting specific industries and customer segments. In the consumer area, one of the reasons behind is that sizable number of companies historically either relied on off-the-shelf credit bureau scores and or outsourced model development and decision strategies to consulting companies. With shifting customer behaviors and evolving macroeconomic conditions, existing business models may quickly deteriorate. And this is what we are observing currently under COVID-19 stress at a handful number of lenders. These models they depend on to run their businesses simply didn't incorporate such assumptions and didn't have similar historical observations to rely on. Conventional sources of 6-12 months data typically used in the credit risk assessment no longer useful in evaluating the resilience of individual borrowers. Fusion of creative approaches to acquire and utilize underbanked related high-frequency data in combination with applying advanced machine learning models to model development and model validation are becoming a new normal. When it comes to a non-retail area, changes in credit worthiness differ by sector and subsector to a greater degree than they did in the previous recessions. Certain industries, such as food distributors, did better in the crisis and struggled to meet their rising demand. Others, such as telecommunications and pharmaceuticals, were little affected. But as all we know, certain sectors, such as travel, transportation, tourism, and hospitality, have been severely challenged. Still, to evaluate creditworthiness properly in the context of this crisis, banks must go beyond analysis of sectors or subsectors and assess individual borrowers. Business models can vary different from one company to another within the same subsector. Some will be more or less suited to survival and a faster recovery in the current environment. For example, a small set of businesses in subsector may have a strong online presence, while others do not. Therefore, banks can conclude from a subsector analysis alone whether a specific borrower is in trouble or not. Banks will have to recognize winners and losers within each subsector. Many lenders are already doing active portfolio and balance sheet management, selling underperforming assets, and reducing their portfolio risk exposure. As there is still a lot of uncertainty on how the post-pandemic recovery will look like, and to what radical transformations in society and ways of doing business will lead to, it is the right time to test new underwriting and monitoring approaches, covering sector analysis, borrower resilience, and high-frequency advanced analytics. The transition to new methods will help banks cope with the present crisis, inform their update to mid-term portfolio risk appetite, and serve as a rehearsal for the step change that credit risk management will have to make in the near future. Forward-looking banks will help and keep their new practices even after the crisis to manage credit risk more effectively while better serving clients and helping them return to growth more quickly. Lenders should rapidly modify their credit strategy covering not only new current exposure management, but also ensure the effectiveness of providing support and solutions to customers in delinquency. Organizations that are slow to make contact as a customer that goes into delinquency are at the greater risk of receiving partial payment or none at all. An effective early warning system will detect customers showing signs of distress. For example, rapid increase in revolving balances, reduced monthly payments, unusual spending behavior, and sudden deterioration of credit score. Typically, early warning systems are built upon traditional data sources and existing processes like this past due, decrease in monthly behavior score, covenants monitoring, quarterly re-rating of customer to check if financial performance and rating are deteriorating, passive rumors, and use monitored by analysts. Most of it is not so early and has a high false positive rate. Bringing into the picture additional high-frequency data in combination with advanced analytics will enable organizations to automate and improve monitoring of early warning signals, indicating potential issues on a customer and a portfolio level in various dimensions. For example, in addition to shared earlier transactions monitoring case, lenders can subscribe and read structured and unstructured data from various news sources in real time, and use advanced analytics to identify those signals which may indicate that there is a potential credit deterioration on a borrower or portfolio level. It might be news related to close down of shopping malls to prevent infection spread, which will impact their ability to repay loans and also collateral valuation. If bank has high concentration in commercial real estate lending, then it might be strongly impacted by it and would need to evaluate further implications by each customer and prepare action plans. Moreover, effective early warning signals can trigger on-time right policies to work with customer on a pre or early stages of debt collection. There is a multiple consideration in the area of collections and recoveries. Social responsibility. Firms need to reconsider vulnerability definition and assessment process. Millions of people are now experiencing financial insecurity for what may be the first time. In the medium to long term, employees of industries hardest hit by the pandemic, such as oil, retail, and travel, may face prolonged unemployment and economic hardship. At such times, it is critical for banks to prioritize the welfare of their customers. Show customers that you care for them. On the one hand, for those in debt or facing delinquencies on their borrowing, it is lenders' responsibility to provide short-term relief from debt payments, while also making payments as simple as frictionless as possible for those who cannot afford them. provide financial fitness tools and helplines. On the other hand, lenders need to keep an eye on customers whose requests for forbearance are unfounded or even fraudulent. Another consideration is related to debt collection capacity. As no one imagined that there will be so many customers not being able to pay for their obligations, collection teams are far from the capacity that is needed. Forming a realistic sense of likely volumes will be the first big task to complete. Next step would require not only expansion of teams, but also review of operating model and increasing automation level. Very important focus area is regulatory-driven changes in debt collection procedures. Some are for the duration of the emergency, some are long-term. In some jurisdictions, supervisors have given a clear steer on what they expect banks to do. In other countries, guidelines are high level, and the decision on ways to execute is down to individual banks. Overall, organizations will need to review and update eligibility criteria and options of existing repayment and forbearance tools. Last but not the least to mention is changing consumer communication preference and approaches, which includes use of out-of-date customer databases, traditional skip tracing tactics to support customer outreach, use of wrong communication channels. All of this is decreasing collection performance. Use of additional data sources, new preferred channels, effective account analytics and segmentation is essential for personalization of contact strategy, identifying opportunities to accelerate assistance for distressed customers, consequently increasing collections performance for banks. Whether it is new customer onboarding, active credit portfolio management, early warnings, or debt collection, all rely on data to effectively discriminate healthy and distressed exposures. As mentioned earlier, the traditional data sources organizations typically use, financial and behavioral, struggle to capture the complexity and pace of the current economic environment. Economic indicators and borrower financial information are often observed on a lagged basis. Certain current indicators are distorted by the private and public relief programs offered in response to COVID-19. Greater emphasis is needed on augmenting traditional data with inference from alternative data sources. Alternative data definition varies by market and is evolving as some sources are becoming traditional and some sources are emerging. Quite often, non-traditional data is able to immediately reflect changes in customer situation as it is linked to frequent behavioral actions, what makes it useful in current situation. For many lenders, new loan applications, payment deferral requests, and transactional data might be the first go-to highly accessible real-time indicator of financial health in both retail and non-retail portfolios. Analytics around the nature of incoming and outgoing payments can provide deeper insights on credit capacity, quality, and behavioral changes, particularly across retail and micro businesses. Analysis of current transaction flow, level, frequency, and volatility against pre-COVID-19 levels can help track the performance and risk of SMEs and the corporates during the recovery period and the low targeted interventions. Going forward, banks should explore opportunities to gain better insights by using a range of other data sources, including value chain linkage data, e-commerce and logistic data, telecom data, utilities and rental payments, browsing data, non-personalized mobile device data like phone usage patterns, data usage, apps, calls. The world is rebalancing, giving rise to challenges and opportunities that are pushing Asian banks to embark on a path of radical transformation. Forefront areas of improvement include digitalization of channels and reimagining customer relationship management, adjusting existing and introducing new products, modernizing risk management frameworks and infrastructure, which covers adopting new data sources and approaches to risk assessment, updating definition of vulnerable customers and reviewing collections and recovery strategies, deploying comprehensive and modernized early warning system. In order to succeed with the improvements, banks will need to deploy cutting-edge tools, technologies, and capabilities. Lenders must start building the necessary foundational capabilities now to minimize the ill effects of the COVID-19 outbreak on their customers as well as their bottom lines. We at SAS are helping banks around the world and Asia Pacific in the various areas of credit risk management. SAS risk solutions are deployed in 60+ countries and used more than 1,500 organizations. SAS is recognized as top 5 vendor in Risk.net ranking for the 10th consecutive year. As one of the responses to COVID-19, we offer banks a number of quick start solutions. You can find information at our global website. Link is in the bottom of the slide. In credit risk management area, we specifically offer SAS Risk Modeling Accelerator, which enables banks quickly pilot above mentioned use cases with limited upfront investment. SAS Risk Modeling Accelerator is a cloud-based offering which incorporates award-winning SAS capabilities in data management, advanced analytics, and risk management. Business users, risk analysts can import existing and new data, do require data quality improvements and data transformations, visualize data to understand correlations patterns, do dynamic visualization to slice and dice even granular data to uncover risk drivers, areas of impact, import existing models, validate against recent data to uncover areas of poor performance and support overlay values, quickly build traditional and advanced machine learning models for benchmarking. It can be done using easy graphical user interfaces and or using SAS, Python, R programming languages. Where needed, models can be combined with business rules into decision flows and executed to simulate implications for a portfolio in case of deployment of these changes, new models, benchmarking models into production. Key reasons why customers select SAS are end-to-end coverage from business and technical perspective, areas of data preparation, model development, model validation, backtesting, business rules management, deployment, execution, and monitoring of models and strategies. Graphical user interface-based self-service risk management capabilities for business users, risk analysts, risk modelers. Easy to manage, configure, and extend usage without further vendor involvement. Broad SAS risk management solutions ecosystem. Multi-use case. SAS tools and solutions can be used for retail and non-retail asset classes, for risk, fraud, and customer intelligence. One of the richest enterprise-supported modeling technique portfolio, from logistic regression and decision trees to deep learning and neural network models. Proven high performance and scalability of products. Thank you. I can see that there is two questions from audience. One is, can you please share more on if and how AI/ML can be applied in credit risk management? And the second question is, what will be the challenge to use AI/ML in the area? Well, I guess in the area of credit risk management. Generally, AI/ML can be used to mine large amounts of data efficiently, including poorly structured and unstructured data sets, and thereby finding patterns and relations that may be difficult to find using more traditional statistical modeling techniques like logistic regression, linear regression, decision trees, and so on. In addition, as I've mentioned already, machine learning algorithms could dynamically adapt to new data and thereby quickly detect changing patterns or allow the use of previously unavailable data in the models. So most popular algorithms in the risk management space, which we're seeing at the moment, are random forest, gradient boosting, and neural networks. Most frequent use for quite a while we've seen of advanced ML and AI algorithms in the area of data collection primarily. We're seeing emergence of usage of the advanced ML in loan origination models, also in early warning signals, both from the perspective of segmenting the customers and also predicting that customer may get into the watch list for corporate customers and things like that. And the other aspect is also, as text analytics is also part of the AI/ML application of the text analytics to see the sentiments on the publicly traded companies, again, to do the assessment of the risk associated with the company from the perspective of credit risk and also ESG, environment, social, and governance risks. The second question is quite good on the challenges to use the AML in the area. On the one hand, as mentioned, there is a lot of benefits. On the other hand, advanced machine learning models brings a lot of sensitivity. And there could be increased risk of retaining false or reverse causal relations that otherwise would be easily detected and removed by human intelligence when you are building logistic regression, let's say. Um, we've done a joint study together with GARP on artificial intelligence in banking and risk management, and we've summarized key challenges around AI/ML application and credit risk management in 5 points. One is data availability, data quality, and biases in the data. The other one is model interpretability. Then the third one is technology changes, deployment, maintenance. Then cost and time to benefits. And the last but not the least is talent and understanding of business and modeling techniques. So if we dive in a bit into each of these topics, so advanced machine learning models are quite good when you have a lot of data. They are very hungry for data to be trained. But then they are very sensitive to the quality of the data. This is basically a statement of garbage in, garbage out is particularly true when we talk about the advanced ML models. They are quite good in uncovering deep hidden connections between the factors, but then they also bring up different hidden biases. Let's say in some countries, females may not have a good access to higher education at universities. And then even if we drop a gender variable from the model, if we use advanced ML model, it can uncover this kind of issue of the limited access of females to the higher education and get and make model biased against females if you keep the education factor within the model. So you really need to look when you are deciding whether you're going to build a traditional model or advanced ML model. You really need to look if you have sufficient amount of the data to train the model, if this data is granular enough, and if it has this kind of a hidden patterns and correlations. Um, then you need to work on the data quality and ensure that you are not bringing in different kind of a biases hidden in. Then the other thing is, as mentioned, model interpretability. Logistic regression is pretty easy to explain why you are getting the specific score or a specific decision. Then when it comes to machine learning models, to high extent, they are black boxes. Even there are different techniques to do the model interpretation, like Lime, Shapley, partial dependency plots, ICE. Still, these techniques have their own limitations, and it requires a lot of engineering around the building the machine learning model to ensure that you are able to explain how the model is producing the results, what are the reasons, so that you can ensure that there is a proper causality, not just the correlations. You are able to explain model to senior management of the bank, to auditors, and to regulators. So the next issue which I mentioned is technology changes, deployment, and maintenance. One issue is machine learning models are subject to a concept drift, and also there is a problem around this data quality, which I mentioned before. So when we are building an advanced machine learning model, we've spent a lot of time on preparing the data, ensuring that there is a good quality so that we build a good model. But then when we put this model into the production, quite often banks do not improve their front-end systems. And there is still this data quality issues there coming into the model, and the model is producing not very good results, especially compared to the development data set. So basically what we're seeing in 90% of cases, as soon as the advanced machine learning model is deployed into the production, it immediately deteriorates. And then there is also a challenge that quite often banks are using open source technologies to build advanced machine learning models, and both programming languages like Python, R, and also the packages which are used to build specific models, they tend to change over the time, and some of them change quite often. There is a lot of versions for them. So that could be an issue that you've developed model using one package, and then when you are deploying to the production, there is another package or version of the package already in the production. And it's good if everything is consistent and you are getting the same results, but there could be slight changes in the package which will mean that your executed model will do calculation differently from what was in the development and validation side, and you again get incorrect results. Then the other thing is cost and time to benefits. As I guess you can feel already, advanced machine learning models require quite a lot of time and effort to do data preparation, data quality improvements, ensure that you are properly deploying the model into the production. And then there is a traditional modeling techniques like logistic regression, which is less sensitive to the data quality, data amount, and it's pretty easy to deploy. And then quite often, if you don't really have data which have this kind of a hidden patterns inside, um, you may not get a significant improvement in the model performance, but you spend more time on the deployment and data preparation. So you really need to check whether it makes sense for you to use a traditional modeling technique or advanced machine learning modeling technique before investing time and money into the development. Then the last part is talent and understanding. What we're also quite often observing that there is a lot of PhDs working on the model development for risk management purposes, but they may lack actual experience in the credit risk management and in banking, and that's where their models may not be performing very well in a production. And also there are kind of different roles which you need to have: data engineering, machine learning model development, some kind of a business overlay. And again, we are quite often seeing that people are just putting one person to do all of these things, and which is not very efficient from the perspective of the quality of models. So you really need to ensure that you have a proper processes, governance, and infrastructure around the model development and the model deployment before going into alternative data and AI/ML development. So I see one more question, but we are regretfully running over the time. So feel free to reach out outside of the session, and I'm happy to comment on that question. So thank you again to joining our session. Have a good day.